Hello everyone, welcome to the lecture 3 of our Sure Short Topics series of the RBWM paper. So all of the topics that we are covering in this series have been asked in the previous examination and there are very high chances of them being asked again. So let us start with the third topic, which is branch profitability and key metrics. So this is from the unit 4 from our module A. We'll be seeing what is the meaning of profit, profitability, and there are certain formulas that we need to have a clear understanding of. So let us start. First, if we try to define and differentiate between profit and profitability, we will say profit is something that is quantifiable, quantifiable, or it is a quantitative measure. But when we talk about profitability, it is not quantifiable and it is qualitative, right? So simply if I am earning certain revenue and I subtract my expenses from it, the remaining portion will be my profit. But if I'm saying how well am I using my resources or my assets and generating some income, then it will be known as profitability, right? So the profitability is the measure of an organization's profit relative to its expenses. So if more assets I'm employing and they're generating more profits, or with the same assets, let's say I'm improving my operational capacity or I'm improving the resources, then with lesser costs, more profits are generated. Then also it will be profitability. And obviously, organizations who realize more profit as a percentage of its expenses are more efficient. So, it is a measurement of efficiency and ultimately an organization's success or failure. All right. So profit is a quantifiable measure and profitability is the relative. Profit is the absolute measure. Profitability is the relative measure. All right. It compares how much profit a company makes compared with its overall revenue and costs. It gives us a more holistic view of how well a company is doing. Here are the points of differences. Profits is the amount your business gains or earns. Profitability is the measure of your business profit. Profit, whatever amount is left after subtracting the total expenses from total revenue. However, profitability is not specific or absolute, right? In terms of percentages or decimals, we show our profitability. So this is the main difference between profit and profitability. I hope it is clear. Now, when we talk about profit, there are certain levels of profit. There's the top line profitability, which refers to the gross sale. Other measures can be the profitability before taxes and expenses. Other could be the bottom line profitability after all the deductions of all the expenses have been made. So there are the three levels of profit. The first level of profitability is gross profit, which is sales minus the cost of goods sold. Sales are the first line item on the income statement, and the cost of goods sold is just below our sales. So if we are making a sale of rupees 20,000 and the cost incurred for making the sale is, let's say, rupees 5,000. Subtracting this value, rupees 15,000 will be our gross profit. So it is the top line of profitability. All right, simply total sales minus cost of goods sold. Then we arrive at the second level of profit by subtracting from the gross profit the operating expenses. Operating expenses are related to the selling, general, and administrative costs. In short, we call it as the S, G, and A, right? So operating profit looks at the profitability after the operating expenses. Similarly, we can also calculate the operating profit margin by dividing the operating profit by the total sales. Similarly, let's say the gross profit in our previous example was 15,000 and the cost incurred on selling, general and administrative costs was around 2,000 rupees. So subtracting it, we will be left with 13,000. And the total sales that we took in our example was 20,000. So dividing 13,000 by 20,000 will give us the operating profit margin. Very simple formulas, but very important. You can easily score marks if such questions are asked. And then we have the final level of profitability, which is the third level and known as the net profit, which is the income left after all the expenses, including taxes and interests, have been paid. So, net profit will be operating profit minus taxes and interest. So, our operating profit was 13,000 rupees. From this, let's say our taxes and interest that we have paid are rupees 1,000, right? So we will be left with 12,000, which is our final level or third level of profitability, right? So I hope all of these measures, all of these lines of profit are clear. And obviously, profit and profitability is also important in the context of banking. Now, there are some traditional methods of profitability. These traditional methods are return on assets and the return on equity. Now, these measures are not used, but because it is important to know what is the meaning, we'll be seeing it. Foremost, we need to see the meaning of assets. What is the meaning of asset? Asset refers to the liabilities plus the bank's capital, which is also known as the owner's equity. So, liabilities plus the bank's capital or owner's equity is known as the asset, right? So, assets are used by businesses to generate income. When we are talking about the bank's assets, loans and securities are the bank's asset and are used to provide most of the bank's income. However, to make loans and to buy securities, a bank must have money, and this money comes from two sources. One, from the bank's owners in the form of bank capital, and second, from the depositors, right? Also, the third part is from the money which the bank will borrow from other banks or by, let's say, selling the debt securities. So that is why we have given this measure assets is equal to liabilities of the banks plus the bank's capital. All right. So the first measure of profitability is the return on asset ROA, which is determined by the amount of income that it earns on its net interest income and fees on its services. Why net interest income? Because banks, they receive interest on their assets, on the loans and securities, plus they also have to give interest on the deposits that they make for their customers. So interest which is received on loans minus the interest which is paid on liabilities. This will be the net interest income. All right. So it depends upon the interest rate spread, which is the average interest rate earned on it minus the average interest rate that is paid on its liabilities. So interest that the banks earn on its assets minus the interest that the banks pay on its liabilities is known as the net interest income or the net rate spread, right? So average interest rate received on assets minus the average interest rate paid on the liabilities. This is the net interest rate. All right, so here's the formula given for the net interest income. Then another measure that we need to calculate the return on asset is the net interest margin. It shows, now questions can come in the numerical form, but they can come in the MCQ format as well. What does the net interest margin of a bank show? And you will be given four options. So you should know the definition as well. That is why conceptual and theoretical knowledge and understanding is very important, right? So the net interest margin shows how well the bank is earning income on its asset. How well the bank is earning income on its asset. A high net interest income and margin indicates a well managed bank and also indicates future profitability. So how do we calculate the net interest margin? By dividing the net interest income that we just calculated using this formula, interest received on assets minus interest paid on liabilities, divided by the average total assets. Average total assets at the opening and at the closing divided by 2 will give us the average total asset. All right, opening and closing divided by 2. And then we divide the net interest income from the average total assets to receive or arrive at the return on assets. This is how ROA is created. How do you calculate the average total assets? Total assets at the start of the fiscal year. At the start of the fiscal year plus total assets at the end of the fiscal year divided by 2. Each and every formula I'm telling you so that you do not have any confusion. And very simple, direct questions are asked from this topic, but definitely it will come. So make sure that you understand these topics very clearly, right? Then, yes, the same formula has been explained. All right, this is how we calculate the average total assets. Total assets at the start of the fiscal year plus total assets at the end of the fiscal year divided by 2. Next traditional method for the profitability of the banks is the return on equity for banks. First, what is the meaning of return on equity? It is what the bank's owners are primarily interested in because it is the return that they earn on their investment. Even the individuals, if we are making investment, the returns that we are generating from that investment is known as equity. So similarly, banks they also invest and the return that they're generating is known as equity. And it not only depends on the return on assets but also on the total value of the assets that earn income. But if banks want to purchase more assets, they will have to pay for it either with more liabilities or with banks' capital. Now, when will it be more profitable for the banks? When they use their liabilities to pay for the assets or they use their own capital to pay for the assets. So, if the owners want to earn a greater return, they would rather use liabilities than their own capital because it increases their return. Again, a very important point. What will be more profitable to the bank? Options will be given. Use their own liabilities to purchase more assets. Option B, purchase more assets with the bank capital. Option C, none of the above. Option D, both A and B. So you should know that banks they need to pay for it using their liabilities because it will increase their return, right? So when a bank increases its liabilities to pay for the assets, it is using leverage. It is leveraging. Otherwise, it would limit their earnings only to the deposit, only to the fees that they can charge and the interest rate spread. All right, it is limited because of the charges which are going on and set by our central authority. And because banks they compete with each other for the depositors and deposits compete with other investments, so the banks must pay competitive market rate. They cannot pay very high or very low rates. They have to maintain the RBI guidelines. Also, they need to be competitive, so they have to follow the market rates as well. So it will be limited. Thus, using the liabilities is important. All right. So banks can only charge so much for the loans since there's a competition. Again, they cannot charge very high interests on the loans that they are creating. So the interest rate spreads are not wide. Banks can earn income only by more net interest income by increasing the number of loans. And it does that by using leverage. How can they give more loans? Only if they have more liabilities or more leverage. So, how do we calculate the leverage ratio of the banks? It is the bank's assets divided by the bank capital. This is again a very important formula. Leverage ratio is the bank's assets divided by the bank capital. All right. For example, let's say the bank's assets are rupees 100, right? And the bank liabilities are rupees 95. So these are the assets and these are the liabilities. And the bank capital is rupees 5. So we can simply calculate the leverage ratio by dividing the bank's assets by the bank capital. So this will give us rupees 20. This is the ratio. So the leverage ratio is 20 is to 1. 20 is to 1. What will this mean? This will mean that if the value of his assets drop just by 5%, then the bank's capital will be wiped out. So, to protect the safety of the banks, the regulators also restrict the amount of leverage that the banks can have. And this is what happened with the subprime mortgage crisis in USA, right? They were using very high leverage ratio during the Lehman Brothers crisis. The leverage ratio was greater than 30. And with the leverage ratio so high, the value of assets only had to decline 3% to wipe out the Lehman Brothers' entire capital. This is the reason why the subprime mortgage crisis occurred. All right. Now let us come back to the return on equity. Now, when we know the leverage ratio, we will simply calculate the return on equity by multiplying the ROA with the leverage ratio. The ROA with the leverage ratio. So ROA, we calculated it by dividing the net income by the bank assets multiplied by leverage ratios formula is bank's asset divided by bank capital. We will cancel out the bank assets from both the sides. Simply the net income divided by the bank capital will give us the return on equity. So this is how we calculate the return on equity. I hope both the formulas are clear. All right. Then the leverage ratio that the banks use is similar to a business using debt to increase its earnings because they have to pay back the debt. Similarly, banks also have to pay back the leverages that they are creating. So all the deposits are just money that the bank owes to the depositors. So the banks, when they're using their deposits, they should make sure that the leverage ratio is not kept very high, right? So the return on equity can be increased by increasing the leverage, but banks can only increase leverage by so much because with increased leverage comes increased risk. That is why even RBI, they restrict the amount of leverage. Typically, the normal leverage ratio is about 10 to 12. I hope all of these topics that we have discussed are clear. The difference between profitability and profit, the three levels of profit, and ROA and ROE. Simple formulas are used to calculate. Even theoretical and factual questions are asked from this topic, but very important. Now, if you have any doubts, any queries, you can let me know in the comment section. I will see you again with the next topic, the next sure short topic. Thank you and all the best.